All right, I'm going to go ahead and get started. First of all, big shout out to CPA Directory for sponsoring us and getting us on their email list. So thank you to you guys over there. My name is Geoff Bruskin. I am the managing partner of White Tiger Connections. We are a consulting firm that specializes in M&A transactions and transitions for CPA and accounting firm owners across the United States. We generally specialize in working in the lower market and the lower middle market. So lower market are firms between 100,000 and $1 million in gross revenue. And lower middle market, we codify as firms between 1 million and 10 million in EBITDA. So it's a pretty broad range that we work with. If you have 10 million in EBITDA, you very well could be a $50 million accounting firm. So we work all the way from the bottom of the market, the small sole providers out there, to firms within the top 100 space. I got into this. I actually started my career in executive recruiting. I am not an accountant. And after opening my own recruiting firm 5 years ago, I was introduced to a PwC retired transaction advisory services partner who, in his retirement, he did strategy work for the executive committees of $100 million accounting firms in the New York metro area. He needed somebody to do executive search for his clients. We did some partner projects together for these big firms, and I got to shadow him on some significant M&A transactions, accounting firms buying other accounting firms. And so that's how I learned the space about 5 years ago now. He retired back in 2019, and my business partner and I put all of our engines into building relationships in the accounting domain and increasing our expertise. We've worked on about 30 to 40 transactions to date successfully. We sold a firm about a week ago to private equity for a little over $6 million. We've done a lot of firms in the six figures, a handful of deals in the mid seven figures, and quite a few in the low seven figures. So topic of today's session is how to increase your valuation when you are thinking about a sale. And really, I would love to get questions in the chat today. So you can just start dropping them in if you have specific questions that are relevant to your firm. Feel free to describe your firm. Feel free to describe some ideas that you have. I'm going to give some quick disclaimers at the start of some of the overarching headlines of how to increase your valuation and what we see our buyers are looking for. So I'll briefly start by saying that we work with three predominant kinds of buyers. We work with accounting firms buying other accounting firms. That's number one. We work with financial services firms buying accounting firms, and these can be either consulting firms or RIAs, broker-dealers, wealth and asset managers, insurance, anybody who's within the greater financial services realm buying accounting firms. And we work with private equity buying accounting firms. And obviously with RSM's most recent investment, they're, I think, number 6 in the country. All of the PE money that has entered the top 100 space, if you follow what's happening in the profession, PE has come pretty far down market, and they are now looking seriously at firms that are as small as $1 million in top line revenue. So, all of these different three categories are buyers that we work with, and they all tend to look for the same kinds of things with what makes a seller attractive to them. And the variables that I'll talk about are meaningful variables regardless of who exactly it is you're targeting to be sold to. So I'll give, I think, 3 examples of headline variables, and then I would love to go into some questions. So the first way to increase your valuation is to get your bottom line number up as high as possible as a percentage of your top line. And I'll give a couple examples. So, usually what we see if it's a firm that's in the 6 figures, is one of two things. Either they are, the owner is either working very much in the business, or the owner is really has been able to work more on the business. And in the business scenario, the EBITDA is going to be low. 15, 20, 25, maybe 30%, including owner salary and owner add backs, that tends to be less attractive. What we really like to see is we like to see the owner who has made the transition into working on the firm where there is staff structures, there are workflow structures in place that have enabled the owner to do more sales and more client relationship management. So I'm kind of cutting into some of the other things that are appropriate for a valuation standpoint, but this is usually what produces higher EBITDA when the owner is less involved in the day-to-day operations of a business. The other scenario is actually quite the opposite. I will give you an example of one such client I'm working with. He does $1.5 million in top line revenue and 1.1 million in bottom line revenue, including his salary, his distributions, and his ad backs. But he works 80 to 100 hours a week during busy season. Very difficult. He's still attractive to buyers because there is so much freestanding cash flow in his business to get creative with, and he is on his way to retirement. That's why he is thinking about a sale, seriously thinking about a sale. But it's going to be difficult because the buyer has to replace that person. So what's going to end up happening in that kind of a deal is he is going to take a very significant salary cut. He can get a tremendous valuation, certainly, but he's going to need to continue working to assure that client stickiness is happening, which of course is what the buyer wants. And all these clients have invested their goodwill with him, the seller. But he's going to take a pretty big salary cut because the buyer is going to need to take responsibility for recruiting his successor. So the higher that you can get your EBITDA up, categorically, number one, the better your situation will be when you are ready to sell. The second thing is you want to get your gross revenue up. And I know this is a tricky one because chances are, if you're watching this recording or if you're here live, you probably have too much business and not enough people to do the work. Which in any profession outside of accounting, we would all be singing about that we're making it rain. But in accounting, and I, as a non-accountant, I graciously say that you all are like the plumbers of the business world. You're doing the job that no one else wants to do, and there are not enough people coming up from college and early career who are competent or who want to do this work. It's challenging to get your gross revenue up. You would certainly take more clients, right, if they were the right kinds of clients. But just taking answering the phone when it rings and taking the next tax return or the next bookkeeping engagement or even the next fractional CFO engagement, if it doesn't fit your ideal client profile, it can be hard to do. Think about creative ways to take the business that comes to you. And we can certainly have a separate conversation. I don't want to get too much into that today, but there are ways through partnerships, through 1099s, through outsourced partners, through remote workers, where if you can find a way to take that top line revenue and own the client, even if you're not doing the work on the client, even if you're not making money off of the client, it is absolutely going to help your valuation if you have a more substantial top line number. As a matter of fact, one of the big differences between that lower market, the under $1 million in gross revenue, and the lower middle market, which is $1 million to 10 million in net revenue, and there's some gray area in there, as you're probably determining. One of the biggest differences is that in the low market, your valuation is taken as a multiple of gross revenue. And in the lower middle market, your valuation is taken as a multiple of net revenue. Now, at the end of the day, this is dollars and cents, whether it's 1 or 1.5 times gross in the low market, or it's 3, or it's 7, or it's 8, or it's 10 times net revenue in the lower middle market. And there's a lot to unpack there that we're not going to get into today. It's still dollars and cents at the end of the day. But if you can, the higher you get your gross revenue and your net revenue as well, the better your dollar and cents figure is going to end up being. So a lot to unpack there, but I'm gonna try to keep it short. Um, and then that third piece that I want to talk about is the niche that you have. The more niched you are, the better. And I know that kind of contradicts the last thing that I just said, but we're talking about objective reality, not just fairness. The more niche you are, the greater your multiple is going to be. And I'll give you some examples of niches. A niche can be high net worth individuals, and that term is defined in a lot of different ways. I see people who define it as W-2 employees who are making over $250,000 a year. I see it defined as people making between a million and 10 million a year. I see it with the million to 10 million in net worth. I see it as over 50 million. If you have a niche, if it's 250 to a million or a million to 50 million, whatever your niche is from a size perspective, I can use that, and other brokers can use that in the narrative construct that we go to market with, to get you a higher multiple. And that comes down to who we solicit your business to. So there are certain kinds of RIAs that specialize in working with certain categories of clients who have a certain kind of net worth or a certain kind of income. Um, Industry is another great niche. If you focus on construction, if you focus on manufacturing, if you focus on real estate, we can think about certain private equity firms that have concentrations there. Of course, we can think about public accounting firms that have concentrations there. Um, so there's a lot we can do with industry focus as well. You don't need to have one niche. You can have several niches. Um, Best if your niches interrelate to one another. For example, manufacturing, supply chain and logistics, and real estate. That's kind of a nice ecosystem of niches that complement one another so that the right strategic buyer would be subjectively, because of their position, able to look at your ecosystem of niches as multiplicative and value add to what they are doing. Not to say that if you happen to work with construction and consumer packaged goods, that we would not be able to do something with that there that to get you that higher multiple. Because there are certain kinds of buyers that will have specializations and strategic business development objectives in those two particular domains. I think that the point is, there's a certain way to go to market where the right broker or the right advisor, and this is not supposed to be a sales pitch, just speaking from experience, we look for buyers who there is some kind of multiplicative or even exponential outcome that your business and the unique resources that your business has, the unique clients that your business has, are going to provide that exponential or at least multiplicative outcome for the buyer. It's different than just an additive outcome. We don't do a tremendous amount of work anymore with public accounting firms buying other public accounting firms. We do that when we're dealing with a 3 or a 5, maybe a $10 million accounting firm that's buying a 500 or a million or a $2 million accounting firm, because it's still small enough that the buyer can see the seller as multiplicative or exponential. The problem that I have found is that these 50, 100, quarter billion, $1 billion accounting firms, if you're a $5 million accounting firm, you're going to be certainly very attractive to these larger buyers. They don't really want too much of the 500 or $1 million stuff, but the $5 million stuff they want. The problem is they have tunnel vision and they have all this anecdotal evidence of the past 50 years of accounting firms buying other accounting firms, and they tend to undervalue you. We look at things objectively outside of just anecdotal evidence of accounting acquiring accounting. You are, as the accountant, one of, if not the most nuclear resource in their life when it comes to advisory. You are dealing with their taxes every year. You are dealing with their bookkeeping and their accounting services for their entity on a monthly basis. You are a very trusted advisor in their lives. And that relationship can be capitalized in a very multiplicative way, not just that additive way where it's seen as one-dimensional revenue. And it's the more nuanced, the category 2 and the category 3 buyers that we spoke about earlier, that tend to be more open-minded, unless it is that smaller accounting firm, that are still somewhat open-minded. The bigger guys tend to think they know everything about everything. Um, so with that, I would love to hop over to the chat. And if you have specific questions, please, please, please ask them. Okay, let's see. We have built one native web app to date that allows us to perform automated R&D studies. How much, if at all, would this increase our valuation? It's a good question. How does this get factored into the valuation? We are debating whether to invest further in building additional native software apps or if it is a waste of time and resources in terms of valuation. It's a great question. It's a very cool product. I would need to learn more about the product to give you my opinion. Um, all things when and this probably is going to sound cheesy, value is always taken in context. It's hard to come up with an objective valuation for anything. There are norms, but especially when you're dealing with software products, um, it's only going to be certain buyers that are willing to see that as having any value at all beyond the core operations of what you're already using it for, right? Um, so, you are using this web app to increase the efficiencies within your firm, and to generate revenue within your firm. Um, the right kind of a buyer is going to see that this product that you are using has value beyond the core operations of your firm. They're going to see that they can implement this product in other aspects of their business, other accounting firms that they've acquired, ancillary businesses where they can repurpose the function for those other services. Um, I would caution you against investing more. Um, and there are other variables involved here, right? How much longevity do you have post integration? Do you have 10 or 20 or 25 years of runway in front of you, or are you thinking more about succession? And by you, I don't just mean you, the owner. I mean if it's you who's responsible for developing this tool, or if there are if you have someone else in your firm who's really driving this process forward. The good thing is if you have longevity, or the person in charge of this has longevity of any kind, and you can demonstrate to a buyer how this is adding value to you and can add additional value to them and their other business lines. Um, you now not only have that asset, the software asset that exists, but you have the knowledge assets of being able to do more, right? Before you find the right buyer, I wouldn't invest more in building a portfolio of products. However, once you find the right buyer, you can adjust the portfolio of products that you continue developing, not only to what is beneficial to you, but also what's going to be beneficial to the combined entity. So it's nice because you have demonstrated that you have this capability and you've demonstrated that it's increasing efficiencies within your system. What you risk by investing more in it is that you're over leveraging yourself, and we want it to be a hook. We don't a hook into more value. I think you're risking value if you invest too much into it preeminently. Um, Software is tough. The other option is that a buyer may want to white label the software that you've developed and resell it, either through a VAR or go direct to market with it, depending on the resources that they have. Um, Again, it's very kind of specific to the buyer. So happy to have a conversation and talk more about it. Hopefully, that's helpful initial context for you. Okay, someone else asked a question. Thank you. Firm is currently growing 60% year over year. I'm not sure how long we can keep the growth rate up for. Should we look to transact before that growth rate drops to the low double digits? Oh, that's a great question. First of all, good for you. Um, Not at all tongue in cheek. That's tough to do. Um, my first question is, why do you think you can't sustain the growth? And feel free to add that into the chat, and I'll think about how to say what I want to say next. Um, so the answer is no. I don't think that you should transact before your growth rate dips. Um, and the reason for that is that velocity of growth is not one of the primary variables that I see buyers looking at to determine valuation, or payment schedule or other material pieces of a deal. Um, and we can come up with and I see that you added context, so let me just finish my thought. Um, we can come up with a narrative for, and I want the real reason, of course, but we can come up with a narrative that makes sense for why the growth rate is dropping. And rate of growth doesn't really implicate value. So I wouldn't worry too much about that. So the reason why you're anticipating growth rate dropping is niche business ideas for an accountant. Look, oh, this is someone else is asking a question. Okay, so whoever asked the last question, if you would like to add any more color on why you think that your growth rate is going to decline, I would love to hear that, and maybe I could add value there. So another question is niche business ideas for an accountant looking to start a business. What will be hot over the next 5 to 10 years? What a cool question. Um, so the most common A class business idea in accounting that I see today, and it is common, but I think it is also A class, is the complementary skill sets of tax advisory and tax compliance and accounting services, bookkeeping, controllership, and fractional CFO. If you are doing the tax advisory and the tax compliance work for the small business owner, small, medium-sized business owner, you're not, your core business is not being a retail tax practice. You are just in that tax vein for the entities that you are supporting in a fractional accounting capacity. Um, you are developing a tremendous amount of advisory equity with those clients. That level of equity is going to be very highly sought after by institutional private equity like buyers who also want to upsell IT services, HR services, wealth management services, and the list goes on and on from that nucleus that you have cultivated the relationship with. Now, I get a lot of questions about, I'm a fiduciary. And, is it a conflict of interest for me to, as a CPA, as an accountant, as a financial advisor, stakeholder, what have you, to, take annuity or take revenue or have financial gain from giving my client additional benefit if we're talking about channel strategy or eventual buy, the acquisition strategy? The answer is, in my professional and personal opinion, no. In no way are you breaching your fiduciary by by participating in the gain that the client is also participating in. And that's the main point. I have 3 RIA clients right now that have retained me particularly for the purpose of building out ecosystems of competent CPAs, simply because their clients, upwards of 50% of the time, do not have an accountant who will respond to the client's email. And it makes it extremely hard and these are RIAs have relatively high net worth customer bases. We're not talking about retail tax practices. And so, we talk about the talent crisis in accounting. It's an opportunity for industrious firms. Channel strategy is a very interesting point that we can talk more about. But back to the point about breaching the fiduciary. Um, Simply that it is the point being, it's valuable to an RIA just to have. They don't even care about an annuity stream. The firms that have retained me, they care about that their clients are getting served. That shows how vital the tax accountant and the fractional CFO accounting services accountant are to the economy right now. So my thesis is, if your client is going to be better off by having their wealth manager, their tax accountant, their CFO, their IT person, their marketing agency, all sitting around the same table and collaborating with one another on the client's best interest. That client is going to be exponentially better off. Why is it a problem, either ethically or professionally, for you to participate in the gain that comes through? You're doing the plumbing. You have gotten in and built this trust because of that crucial pain in the butt function that you are performing for the client. Why should you not also be able to bring in other trusted service partners and participate in the financial outcome that comes from your client's best interest being served? I truly believe that that is fair and appropriate, and clients don't have a problem with it either. In my experience, 80+% of them do not. So if you're thinking about an acquisition strategy, that tax and those accounting services, that tremendous trust that you are developing with that higher net worth business owner class, is probably the most common, most A-class and accessible opportunity that I see for firms who are just starting out. It's where I would advise you go. Okay. $8 million advisory firm in a niche market, single owner, considering exit in 3 to 5 years. Some are senior and ready to retire prior to owner retirement. Just brought in client development function to augment owner business development efforts. Excellent. Will a near-term dip in EBITDA due to no revenues from a sales function impact valuation? Yes, it will. And I can provide some advice on what you might do to offset that. But the bottom line is yes, if your sales are dropping, it is going to impact your valuation. If I was representing you, it would not impact your valuation by orders of magnitude. But on an $8 million firm, I don't know what your EBITDA is, but I'm going to make an assumption for the sake of time. If your EBITDA is 30%, we're talking $2.4 million. And if you're an $8 million firm with a $2.4 million EBITDA, you are probably looking somewhere in the ballpark of 5 to 9 times an EBITDA multiple, depending on a number of factors. So let's take the middle number and say 7. 7 times approximately $2.5 million, we're talking $17.5 million is the exit that we're targeting. You're not going to get 100% of cash up front. The right PE firm would pay you 50 to 60, maybe 70% of that cash up front. Maybe. So let's say we're talking about $10 million in cash. That other $7.5 million that we're targeting, if your sales are dipping in the near term, we could be talking about $2.5 million in value, right? And I mean, obviously, I'm just making up numbers, but there's no, and this is a great point. There is no formulaic way of calculating for adjustments to fair market representations of your valuation, and even fair market is gray. Remember, perception is always, value is always in the eyes of the beholder. So we can, when I give that 5 to 9 multiple range, there's a lot of factors from your firm that will dictate where a fair market, by my opinion, value of your firm should be. But even the right buyer is going to use everything that they can to, I really want your firm. And then as we start getting into brass tacks, they're going to find anything that they can to bring your valuation down. The earlier question about velocity of growth, that's going to bring your value down too, but it's going to be a B or a C class issue. Objectively, it is. A dip in sales, right? So if we're talking, 60% to 15% growth is a B or a C class issue. 20% growth to zero growth or to negative growth, that's going to affect your valuation as an A class issue. So hopefully that answers your question. And I'm be thrilled to go into more detail with you about that privately. Okay. Oh, chat was disabled. I'm sorry about that. Oh, this is from the earlier question. Don't really have a good reason why the growth rate might be slow, other than it seems too good to keep up indefinitely. Well, I appreciate your conservatism. Um, I don't think that, and look, I would benefit by you engaging me and having me sell your business sooner, right? I always like doing deals now as opposed to 3 to 5 years from now. Um, but I want to give you good advice, not advice that's good for me. Um, I wouldn't worry too much about it. That's my gut instinct. Let's talk about it privately if you want more of an opinion. But it does not seem imminently threatening to your valuation from my intuitive read. When determining EBITDA for the valuation multiple, how much of owner compensation do you add back? That's a great question. For example, my business partner and I currently pay ourselves outsized bonuses post-tax season that make our book net profit look much lower than it really is. You and everybody else. That's a very reasonable thing that you do. Um, how much of owner compensation do you add back? All of it. The answer is all of it. In the world of valuations, and I am not a CVA, but in the world of valuations, um, we who do valuations for a living want to know where all of the bodies are buried. And I give Tony Tomorrow from Grassi, who is a friend of mine, credit for that phrase. It's really very true. Um, the reason why is because remember, if we're in the lower middle market, which is where I want you to be, so that you're getting more dollars and cents at the end of the day, that $1 million plus EBITDA number, um, your multiple is going to be taken on the EBITDA. So the higher that the adjusted EBITDA is, including owner add backs, the high, a three times multiple. What do you want? A three times multiple on 1 million or a three times multiple on 1.2 million? Obviously the latter. So when I'm engaging with you, I want you to show me where every single body is buried so that we can add every opportunity of number back into the value, back into that EBITDA fixture. So hopefully that answers your question. Happy to go into more detail on that. How long of an employment agreement are you seeing buyers request from sellers who are retiring? How common are earnouts in recent deals? Earnouts are very common. I'll put it this way. It's rare that earnouts do not happen. Very rare. Um, Pre-COVID, and I've only been doing this for 5 years, but pre-COVID, um, it was more common for 100% cash deals to happen because why not? You can get an SBA loan, you can get a small business loan, you can get a bridge loan, you've got freestanding cash, and if you're a small accounting firm, you can put that into, or a medium-sized accounting firm or a large accounting firm, you can put that in. um, Post COVID, it is very rare. And I actually don't believe in 100% of cash payouts. And I really try to remain neutral and fair. I don't think it makes sense. The reason I don't think it makes sense is because we are in a services industry where what a buyer is buying is the goodwill that your clients have with you, the seller. So, if we try to take the business and the money out of it and we think about what is fair and what is right, and maybe I'm an idealist, but that's who I am. Um, you know, 30, 50, 70, 10% of cash. These are the things that I see. The 10 situation is a merger. It's a long tail acquisition where there is the opportunity for the seller to earn more. You've got 10 years of runway. You don't want to sell. You don't want to give up control. It's about platform. It's about exponential opportunity for your earnings and for your liquidity to be a factor of your earnings. But really, it's about your earnings, more about your salary, your bonus, and your longevity. 30, 50 is more common in what I'm seeing. And I would say probably the most typical. And that is because the buyer wants to incentivize the seller to help with client retention. Now, if you're getting 30 or 50% of cash down, you are going to have an employment agreement. You've got generally three aspects of your compensation. You have base salary, which could be either hourly or W-2, or a percentage of your billings. You have bonus for continuing to grow your book of business and bring new clients, net new clients into the firm. Um, and then, upselling is usually a component of the last piece, which is your earnout. And the earnout, there are a million different models for it. But, so your question was really around how long. The shortest that I see is 3 to 6 months. In some cases, I do see that when the seller is really ready to get the hell out. And usually they're not gonna get as aggressive of a valuation as you could get if you were willing to have some longevity, because it's a bit of a different narrative that I have to go to market with. Um, and I would say most typical is probably 18 months to 3 years. And I see 4, 5, 10, as I said. It can really be anything. There is a buyer out there for your practice. The question is, how do we maximize your value, and what is your lifestyle bandwidth for remaining involved? And that's what I work with you on in an engagement capacity, as we set the tone for a go-to-market strategy. Okay, what does a typical PE transaction look like? As you mentioned, 50% may be paid up front in cash, but is there typically an earnout period or something for the owners where they would be asked to stay on for X number of years? So that's an extension of the question I just answered. So I will use this recent deal I mentioned at the beginning of our webinar, the firm that sold for a little over 6 million, as an example. This firm got approximately about 40% of cash up front on that $6 million transaction. They got a salary as well. So he was doing well over $1 million in adjusted EBITDA, and he got a smaller salary, so 500 in the first year, 350 in the second year, and 300 in the third year. And the earnout period was over 4 years. So he has the option of staying on for the fourth year in an employment capacity, holding salary at that 300 level, or could retire earlier. But of course, part of the earnout is retention. So the gray area of, well, are you going to have my successor hires private equity firm that bought him? Are you going to have my successor hired? How is things going from a workflow, a technology, a client experience standpoint? He wants to get out as soon as possible, but he wants to maximize his, obviously, valuation liquidity. So the gray area was solved for by his option to stay on, but it not being required. 18 months to 3, 4 years is generally what I see, most common. So if this was valuable to you, I would love for you to subscribe to our newsletter. You can go to www.whitetigerconnections.com and fill out our form on our homepage, and we'll add you to our weekly newsletter. We talk about trends that we're seeing in the industry. You're always welcome to book time on my calendar. You can find me on our website on the About page. We're on LinkedIn. Connect with us on LinkedIn. Again, a big thank you to CPA Directory for giving us this opportunity to connect with their audience. Our mission is really to provide white glove service to the low and the lower middle market in accounting, because it is the wild, wild west out there. And education on how these deals go and access to really great opportunities can be hard to come by. There are some very gray-haired incumbents in the space that, like I said, have that tunnel vision. And my hope is to provide ethics that are deserving of your legacy, because this is your life's work if you are thinking about retiring, and you should be treated fairly. Hope somebody treats me that way in a million years when I retire. I have 2 kids and they eat everything. Thank you all for being here. Pleasure being with you. Have a great weekend. Bye-bye.